Hi, and welcome to part 2 of chapter 16, Current Liabilities Management. So we're going to continue our conversation about unsecured sources of short-term loans, bank loans. Now, if you have a bank loan that requires an annual cleanup, that means at some point within the year you have to pay back all of the money you borrowed and bring your current balance to zero. So at one point during the year you have to pay back everything you borrowed in your account to make sure that it stays in a short-term nature. Because if you were to take a bank loan and keep it as an extended balance and never pay it back, it's really becoming a long-term loan, and for that, rates should be higher. Okay. Now, let's talk about revolving credit agreement. So, a line of credit guarantees a borrower by a commercial bank regardless of the state of the credit market money. So it's an agreement, sort of like if you got a home equity loan, that would be a revolving credit where there's a certain amount of money that you can withdraw up to, or certain home equity loans are like this. And it's just like a credit card is even the better example. So you have a line of money which you can borrow. It could be for a business, it could be $1 million, and it's at the business's discretion. So the business has it sort of like you do with a credit card. It's a backup in case you need to make a big expense. You could buy it on this revolving credit and pay it back. And that once you pay it back, so say you have $1 million revolving credit, you borrow 200,000, you pay the $200,000 back, you still have $1 million to borrow at any time. Sometimes they do require a commitment fee, and this is a fee that is normally charged on revolving credit agreements, and it applies to the average unused portion of the line of credit. So the fee is applied to any unused balance. So normally it could be, say, 0.5% of interest. So if you have $1 million revolving debt and you're only using 500,000, or say you're using 600,000, the 400,000 you're not using, there's sort of like a commitment fee. So you want to be very careful with this revolving credit agreement not to have more credit than you need. Just like with your credit cards, you don't want to have more credit card revolving debt than you need to. Here's an example. REH Company has $2 million revolving credit agreement with its bank. Its average borrowing under the agreement for the past year was $1.5 million, and it has a commitment fee of 0.5% of interest on the average unused balance. So the portion that would refer to the commitment fee would be 500,000. So that's the $2 million revolving credit minus the 1.5 million average balance, average borrowing. So we would take the 500,000 that's not borrowed, and we hit it with the commitment fee of 0.5%, 0.05%, and that'd be $2,500 as far as additional fee. Now, they've agreed to pay interest on the 1.5 million borrowed, and assuming that the interest is 112,500, the interest was paid on the 1.5 million borrowed, so effectively that becomes more like 115,000 if you add in the commitment fee. So if we divide that by the amount actually borrowed, we come up with the actual rate. So you can kind of add the commitment fee into that rate. Now, commercial paper is a form of financing. Generally, it's a short-term financing, and it's from the most well-established companies. So it's an unsecured promissory note that a company issues commercial paper that they just issue it, people buy it, and the company promises to pay you back. So that's why only large, very well-established firms can do this, because they have the financial credit to do this, clout, credit history. So the commercial paper have maturities anywhere from 3 to 270 days. Now, commercial paper is more of a short-term loan, and there's no set denomination. It could be, anywhere from 100,000 to 100 million, depending on the size of the company. And most of this commercial paper is going to be issued through finance companies, investment banks, and a lot of this is through manufacturing companies, by and large, are the ones that um, will account for some of this. Um, Financing needs. I mean, really, any company that's of sizable nature and has a established business can issue the commercial paper. Now, the commercial paper market, it's has its own dynamics. So, following any difficult economic or credit environment, in post September 11th era, um, we had historically low interest rates with corporate companies issuing, um, wanted to reduce their exposure to refinancing risk, and that had depressed the effect on the commercial paper volumes and quality through 2001 to 2003. And 2004, that volume changed and ratings concentrated in commercial paper were coming to an end. So in 2006, commercial paper surged to about 2 trillion, or a 21% increase over 2005. And then we had a peak of about 2.2 trillion before post the 2008 crisis. After the 2008 crisis, when the commercial paper funding facility began to operate to provide liquidity as a backstop against these commercial paper insurers, and this closed in 2010. Once it was considered, commercial paper was a much smaller market prior to the financial crisis. So the commercial paper market changes in size and directness, and it's also related to credit crunches and credit expansions. And credit's been since 2008. Credit's been pretty well expanding and made money's been pumped into the economies of the world, which has made the issuing commercial paper once again popular, and expanding it again recently. If we look at unsecured sources of finance, short-term loans, with commercial paper, we can look at this shipbuilder, which just issued $1 million worth of commercial paper, and has a 90-day. This paper has 90-day maturity, and it sells for $990,000. So at the end of 90 days, the purchaser of this paper will receive $1 million for its $990,000 investment. So it's selling at a discount, and the interest paid on the financing is therefore $10,000 on the principal. So the effective rate would be 10,000 divided by 990,000. So assuming the paper is rolled over every 90 days, and that's 4.06 times a year, the effective annual rate, which we learned in finance class in chapter 5, time value of money, is 4.16% annually. Now let's look at some lending limits. So commercial banks are legally prohibited from lending amounts in excess of 15% plus an additional 10% for loans secured readily by marketable collateral. So the bank is unimpaired. So of the bank's unimpaired capital and surplus to any one borrower. So this law prohibiting banks to limit their exposure is meant to help protect banks and not to get too much of the lending tied up with one customer. So it's intended to protect depositors. Since the bank is lending depositors money, they want to put some laws in place to protect the activities of the bank so that the depositors don't risk losing the bank going bankrupt and the depositors losing their money. That's anything outside of what's insured by the government. So smaller commercial banks do not have many opportunities to lend large, high volume to large amounts of money to large quality borrowers. So it's sort of the larger banks that engage in most of this. Now, if we're talking about international loans, important difference between international and domestic transactions is that payments can be made and received in foreign currency. Now, not only must a U.S. company pay the costs of doing business in the foreign exchange market, but most will also be exposed to this foreign exchange risk. So if you're an American company and you're going to take a loan in pounds or in euros, that's going to expose you to this foreign exchange risk, especially if you're earning money in dollars. Now, if you're an American company and you're setting up a European operation that's going to earn euros, it might make sense to borrow in euros, since the revenue source that's going to pay back that loan is also in euros, and that's why typically companies may take loans in different currencies. So typically international transactions are very large in size and has much longer maturity. So you don't get involved in this type of lending unless it's a big amount of money that you're borrowing or lending. Um, and in most cases, it's foreign companies borrowing in dollars, not American companies borrowing in foreign currencies. So because the foreign companies are rarely well known in the United States, some financial institutions are reluctant to lend to exporters or importers, particularly smaller firms. So, once again, the size and the quality of your company comes to play into what financial markets you can access and what type of unsecured debts or loans you can get involved in. Now, if you're a very small company, and this is, I remember this is one of the first areas of accounts receivable I got involved in was learning about letters of credit because we dealt with, at the time I worked for a defense company, and we dealt with many smaller companies in Asia, and we would generally work through a letter of credit. So what this is we work with a bank, and the bank is going to guarantee that the foreign supplier is going to make the payments based on what we're selling them. So if we sell them components or computer components or chips or whatever pieces of equipment, we would get a letter of credit. So this foreign bank would guarantee that these other companies or governments would pay us back. So it substitutes the bank's reputation and creditworthiness for the commercial customer. So if you can't trust the commercial customer, or they're too new of a company or too foreign of a company that you really can't really trust that they'll pay you back. And it was quite common for foreign companies to borrow on accounts payable materials from American companies and then decide not to pay them back and go out of business, and then they start up a business somewhere else and do it again. So these letter of credits were established as a way to enhance trade and guarantee payment. So you're going to be more willing as an exporter to work with foreign companies if they have letter of credit and the bank's going to guarantee payment. But these letters of credits are pretty tricky contracts, and there's a lot of fine print and legalese in them, so they're not the most easiest thing to work at, and they generally have to be negotiated between two companies before a letter of credit can be accepted, and the bank will guarantee payment. Now, secured short-term financing, this is a loan, specific assets pledged against collateral. So again, if you're a small company and people don't know you as well, they may be reluctant to lend to you, but if you can put up some sort of collateral, and that's the one reason that individuals like you and me can buy a house with only 2% down or 5% down, because the collateral of the house is what's really securing the loan, not your credit worthiness. So as long as you put, that's why they only require such a small amount down when you buy a house, because of the collateral. So the collateral for a company is going to take the form of accounts receivable or inventory, and that's going to be the holding collateral that can reduce the cost of borrowing. And if the borrower defaults, then the lender will get the collateral as protection or as payment. So it's a security agreement. So it's an agreement between a borrower and a lender of a specific collateral held against a secured loan. So this is now why we call it secured. It's secured with a security agreement, which is going to be based on an asset. It's going to be filed with public office within the state, county, or country to make it legally binding. So here's some characteristics of a secured short-term loan. The percentage advance. So the percentage of the book value of the collateral that constitutes a principal of a secured loan. So normally between 30 to 100% of the book value of the collateral. So commercial finance companies are lending institutions that make only secured loans. So commercial finance companies make the secured loans, but short-term and long-term, both short-term and long-term secured loans to businesses. So they're not like banks. They're not permitted to hold any deposits. So these are specific lending entities of commercial nature. They're not savings and loans type of banks. Now, you could use accounts receivable as a company, or a company could use accounts receivable as a way of obtaining some short-term financing. So accounts receivable is an asset. It's money that people are going to pay back to your company for this because you sold them some products. So you can pledge your accounts receivable and what we call factoring accounts receivable. So you can pledge um, accounts receivable as security collateral for a short-term loan, and factoring the accounts receivable, which is the outright sale of the accounts receivable at a discount to other financial institutions. So you say you have your accounts receivable, 100% is $100 million, but you're going to factor it down to 80% to get the $80 million. So you're basically selling it at a discount. So factor is, a financial institution that specializes in purchasing accounts receivables from a business. They'll sort of take over the collections of it. Now, the pledges of accounts receivable are typically made with what we call non-notification basis, which is the basis on which the borrower, having pledged the accounts receivable, they can, in many cases, collect the payments without notifying the account customer. So basically what it means is the company is going to still act as the collector of the money and then pay back the person who has the secured loan. The alternative, notified notification basis, is an account where the customer whose account has been pledged or factored is notified to remit payment to the person who lent the money. So that could be embarrassing. So most companies prefer non-notification, so the customer really has no idea that the accounts receivable is pledged. And why would they want to do that? Because a pledged accounts receivable may show some financial turmoil, some financial risk, some financial insolvency at the company. So the notification basis is the rarer of the two. So receivables trading. So in 2007, the Receivables Exchange is an online market where organizations such as hedge funds and commercial banks looking for short-term investments can bid on receivables pledged by small, medium-sized, and large companies. So they made a marketplace for these types of receivables. And companies who need cash can put their receivables up for auction in this market, and investors can bid on them, making it much more liquid and quicker to set up this arrangement. So in the first few years of the operations, the Receivables Exchange provided funding for more than $1 billion to companies selling their receivables. And it attracted the attention of the Euronext, which purchased a minority stake in this exchange in 2011. Again, when they put this Receivables Exchange together, they added liquidity, they added a market, and they made it much easier for companies to pledge their receivables and receive money up front for money they'd lent to other customers in the past. Now, secured sources of short-term loans, the use of accounts receivable as collateral. So, factoring is normally done as on a notification basis, and the factoring receives payments of the account directly from the customer. Now, in addition, most sales of accounts receivable to a factor are made on a non-recourse basis, which is a basis on which the accounts receivable are sold to a factor, which with the understanding that the factor accepts all credit risks of the purchased accounts. So this means that you're transferring the risk of collection, which, depending on when you actually are going to transfer the risk of collection, the factoring has to be more generous to the person lending the money to make up for the fact they're going to be assuming the bad debt risk. So let's look at this factoring situation. With the use of credit cards such as MasterCard, Visa, and Discover, consumers have similarity with factoring because the vendor that accepts these cards is reimbursed at a discount for the purchase made on the card because of the transaction fees. So the difference between factoring and credit cards is the cards are nothing more than a line of credit extended to the issuer, which charges the vendors a fee for accepting the cards. Now, so American Express charges the highest fee, close to around 3%, and Visa and MasterCard would charge a lower fee, closer to 2.5%. So the factoring does not, analyze credit until the sale has been made. And in many cases, the initial credit decision is the responsibility of the vendor, not the factor that purchased the account. So, in your own life, your credit cards are somewhat small. A small amount is factored to the people issuing the credit cards. Now, secured sources of short-term loans, we look at inventory as collateral. So a company's inventory can also be very valuable and can be used as collateral. But all inventories are different. So some inventory is much more valuable than other inventory. So if your inventory was gold-plated um, jewelry or gold jewelry, as a better example, that's a much more valuable inventory than if your inventory was computer processors that can easily get outdated or out of or lose value. So the characteristics of the inventory has to be evaluated for the credit worthiness and the collectability. Now, a warehouse, full of say perishable fruits and vegetables is not as desirable as a warehouse full of gold. Not that that exists, but some specialized items such as um, things that aren't sold that frequently, it may be harder to turn into cash or less liquid, would mean that they're less desirable as collateral. So inventory that can more easily be sold is going to have a higher value and is going to be better collateral. So a floating inventory lien is a secured short-term loan against inventory under which the lender's claim is on the borrower's inventory in general. So it's just whatever their inventory is, it has to be quantified and notified, but the arrangement is attractive when the firm has a stable level of continuous inventory uh, from a diversified group of relatively inexpensive, hopefully high liquidity merchandise. But it's difficult for the lender to verify the presence of all the inventory, where it is, and how much it is in advance, or less than, so lenders typically advance about 50% of what they're saying the book value, the company's saying the book value of the average inventory is. And the interest charge can be 3 to 5% above prime. Now, a trust receipt inventory is an example where you may have, maybe your inventory is automobiles. So you're going to secure the inventory loan against 80 to 100% of the cost of the relative expenses of the inventory items in exchange for the borrower's promise to repay the lender with accrued interest after the sale of each item. So with a trust receipt, there's the borrower is free to sell the merchandise, but is trusted to remit the amount lent back to the person. So it's basically a trust situation here. So you say, listen, I have all these automobiles that equal $100 million worth of cars, and I want to borrow 80 million or 80% of the inventory, and as I sell those cars off, I'll pay back the loan after the sale. Now, say you had those cars in an independent warehouse, and we could make something called a warehouse receipt loan, which is again a short-term loan with inventory as collateral, which the lender receives control of the pledged inventory. So the inventory leaves the manufacturer and it goes into a separately controlled warehouse, where now the lender is the one going to receive the control and the location of the inventory. So is going to store the merchandise in a neutral location where it can be verified and counted more easily. And under the warehouse agreement, the lender hires a field warehousing company, and then they set up the warehouse, and on the borrower's premises sometimes to lease part of the borrower's warehouse or store the pledged collateral, and as the collateral is being sold, then the loan gets paid back. But you're pledging, I have all these cars, I'm going to pledge these, 3,000 cars to be the collateral, and as those cars are being sold, the money gets paid back. Okay, so that noise tells me that we're at the end of the lecture. So I hope you enjoyed this lecture on current liabilities management, and it is certainly an important and crucial aspect of financial management is the proper management of the current liabilities. And as we saw in this lecture, part 1 and part 2, whenever you're borrowing money, whatever the terms are, you have to factor in all the costs into an annualized effective rate. So whether it be the cost of holding an additional inventory, or the cost of holding collateralized accounts or security balances, or additional fees or obligations, all of those should be monetized, annualized to come up with a annualized rate of what your short-term liability is. So that way they can be comparable, and these should always be compared against your cost, your return for your investments of your money, and to get a better idea of how much you're paying on what's being lent to you. So hopefully the key goal is here. We want to borrow at a lower rate than what we could get in return on in our business operations. Okay, so this is the end of part 2 of chapter 16. Take care.